Hi, my name is Patrick Claudius Oluwadamilare, and in this pitch deck, I'll be discussing on corporate tax return analysis. So sit back, relax, and follow me. Starting with the introduction, corporate taxation. Essentially, corporate taxation is an important factor that stays on the front burner of every organization as it helps to manage their tax liability and, of course, help the organization to stay away from whatever penalty that may ensue out of failure in tax remittances. Right. So basically, if we are looking at what taxation is all about, so this is more like the liability of organizations and every individuals to the government of the country of the state where the business operates. Right. So, however, government is not directly required to provide details of what tax is being spent upon. Nevertheless, we have an idea that this is used towards developmental projects to keep the environment, to build infrastructures that, of course, help businesses to thrive better in that environment. One of the key factors to note is the fact that tax laws differs from country to country, and of course differs from state to state. For instance, in Nigeria, we could have there's federal tax, requirement. The state also sort of have their own tax requirements, and you still have the local government that still have their own tax requirements. So in several instances, you have organizations who remit taxes to all of these three bodies. Right. So with regards to this analysis, the focus will be on the US. Um, and of course, in 2017, the administration of President Donald Trump came up with a new tax review which reduced the taxes paid in the US from 35% to 21%. And this, took effect in 2018. And the idea behind tax review and the differences in tax law is sometimes based upon is sometimes a means to adjust to the present economic realities in the country, right? So government have this adjustment to sort of help cushion the effects this may have on the organizations operating in that within the country. And so other key factors that is usually very important to tax remittance is the fact that it is expected that it gets remitted 15 on the 15th of the fourth month within every accounting year. And of course, government allows installment payment, especially on estimated taxes from mid-April down to June and September, right? Which is sort of to help if organization is struggling to pay all at once, right? So moving forward, another key important factor to note in this analysis is the fact that organizations' decision or individual decisions can have effect on the tax burden that such organization will be exposed to. For example, decisions regarding when equipment is purchased, when certain expenditure is being carried out, when a certain investment is being made, will have effect on the tax liability of the organization. This will be discussed further as we progress in this discussion. Now, strategy to lessen tax burden, right? So essentially, why tax remain an important requirement for everyone and every organization uh, kind of can never escape. Yet there are legal ways that has been provided for organizations to sort of reduce their tax liability, and some of these will be explored further. One of them is the possibility to earn tax-free income, and this would include investment towards bond, health savings, and all of that. So investment into bonds help organizations to make profit. As we know, some bonds have certain amount of profit or percentage of profit that is placed on them. And so when an organization invests into free bond, it means that whatever profit that is generated from that investment will not be subject to tax. Organizations can earn those profits without having to pay tax on them. Investment into health savings can help organizations to also earn some profit on investment without having to pay tax on those profits when they are made. But another key factor or key strategies that can be used to reduce tax burden is investment in qualified opportunity fund. Right, so qualified opportunity fund are usually strategies that government use to bring development into certain environments within the country. So for example, in Lagos, there's a place called Lekki Free Trade Zone. Right, so what government does with that zone is that they allow organizations to come in and set sites and set up their industries, their business in that place, and to be able to enjoy tax-free benefits. So the idea is to help the environment develop, to make sure that industries are concentrated in that environment, create jobs for the people that live in that environment, while the organizations get to enjoy, get to stay in that place without having to pay any tax to government. So one of the ways organizations can use this is sometimes to when profit is made, right, that profit can be directed towards that environment. They can use it to purchase profit in the environment that government has classified as qualified opportunity environment. So when such investment is made into real estate, right? So we do know that real estate in its own has the power to generate to appreciate in value over, say, a period of 10 years. So when such real estate is being disposed, we know profit is not, or tax is not paid until cash is earned and profit is made. And so when such real estate is being disposed in that period of 10 years, then the organization can then choose to pay tax on profit made, right? And this would of course be another advantage, because that investment initially was meant to go out in the form of taxation, but now it is coming in as another investment to the organizations. And sometimes organizations can choose to even wait till there is a tax-free holiday before such investment is disposed. Another factor that can be leveraged upon is to understand the deductions that can be made. For example, cost of operating from home, using personal equipment like printer, personal computer to run the business. All of these can be deducted from, they can be added to the business expenditure, which would of course reduce the tax liability of the business. For example, if a business is operating from home, you have water bills, utility bills, electricity, and all of these can be deducted from the tax liability of the business. Also, another crucial factor is the timeliness of investment. So if an organization if it's planning a project, say for next year, right, whatever major equipment or tools that is needed in that project can be purchased, say, around October, November of the present year, which would of course reduce the tax burden for that same year. And then when it gets to the next year also, organizations will always have project they are banking upon. Similar process can be similar process can be implemented to reduce the tax burden that will be going into that next year. So these are key ways. Timeliness of investment sort of help organizations to bring down their tax burden when organizations take strategic approach when investing, as against when that expenditure is taken towards the beginning of the next year that the project is to be implemented. So this can sort of help organizations to reduce what will be going up in taxes. Another one is investment towards employee development. So this is something that is usually a win-win to the organization. When an organization invests to the skill set of its workforce, what that does is on the long run it improves their efficiency, which sort of help organizations performance, right? So what they do with this is so for instance, there could be investment towards training of the employee, investment towards other developmental program to help them upskill their skill set, um, help them perform better in their role, and of course, this would help the organizations to reduce tax burden. Also, contribution towards 401k plan. This is another benefit that helps organization to attract top talent. I can remember in my experience as a recruitment specialist, I realized that one of the top questions that the candidate usually ask me is if the organization is to know the kind of benefits they are likely to enjoy in the organization. So whenever they hear that there are certain benefits like 401k that meets that the organization will be giving them, they are more interested in speaking with me, and they are more interested um, in working with the organization because they know that there will be a benefit they can enjoy. So this sort of help to attract top talent to the organization, and of course help the organizations to reduce their tax burden as well. So is the investment or contribution towards 401k plan is a win-win thing for every organization when they do it, and of course this help to reduce tax burden um, when it is adopted. Also, business location, which is quite similar to the one stated earlier. So the location where the business is operating is another crucial factor, right? So if the business is sited in places where the government has decided that when business go into that environment, they have some benefit they get to enjoy. This also help in reducing tax burden. Charitable donation, especially charitable donation that provide benefit in returns, such as advertisement. So if an organization donates to a cause and the cause is willing to give the organization a space for advertisement, a billboard space for advertisement, this can be classified as a form of business expenses on the financial statements, which would sort of help the organization to reduce tax burden. I could remember that sometimes ago the telecommunication giant in Nigeria, MTN, so they have a plan that is similar to this. If you want to hold an event, especially a public related event, right, and you're using a big hall, you approach MTN. So MTN will come to the hall, look at the hall, find out if you are willing to leave whatever they put in that hall for 1 or 2 weeks. So MTN will come in, brand the hall, and give you some money, say 2-3 million, while still helping you to brand, decorate the hall, make it attractive and beautiful. Right. So to MTN, this serves as a form of advertisement, while the owner or the organizer of the event get to enjoy the benefits that comes from whatever financial support you are getting in that regard. And so in the next slide, we'll be looking at some of the regulatory or the compliance, some of the things that organizations will need to comply with in using all of these strategies. Right, so compliance for the strategy with regards to charitable donation, right, up to 10% deduction can be made within the year on adjusted gross revenue, provided it is listed on the tax income. So so what this means is if there's anything that goes beyond this 10%, right, this can be shifted forward to the next year before the deduction is made, right? So this is based on what the IRS expect organizations to follow. And with regards to investment in employee, it is expected that organization must the investment must be ordinary and it must be necessary, right? It shouldn't be something that is not really important. If it is investigated, it has to be a necessity. It must be within a reasonable figure. It shouldn't be over bloated. There must be an evidence of service provided. So there must be, if the organization is being investigated, if it's being audited, right? So there must be an evidence to prove that this money has been spent. It must be incurred within the year in view, right? So if, like I said earlier, if anything, if it's exceeding what is required, it can be shifted toward, the deduction can be shifted towards another year. In terms of investment in property, it should be noted that return is not expected until cash is made. And so one of the ways organizations can stay in compliance in this regard is to ensure that to make sure that the property is not sold. The property can be retained for a long time, even to the period when there will be tax holiday before the property is disposed. A longer period until a reduction is until the organization knows, yes, can confirm that this would lead to reduction in their tax liability. Contribution towards employee retirement, of course, the IRS expect that this must be within the stipulated range and it must comply with the IRS requirement. And so, for instance, for an organization to be able to contribute towards 401k, the organizations must have registered with 401k plan, right? So, because if organizations claim to be making deductions in this regard and the organization is not registered with 401k, then it means that deduction it means that the organization will be going against what the IRS has stipulated, and this may lead to a penalty. And it must be within the maximum amount that the IRS has stipulated. And so these are some of the compliance strategies, the key factors to note when adopting those tax reduction strategies. I hope this does a great justice to the requirement of this presentation. The next slide, this speaks about some of the resources that was used to prepare this slide. Thank you.